Mr. Loh Boon Chye became CEO of the Singapore Exchange in July 2015. At a time when the bourse operator was struggling with lackluster trading volumes and declining investor confidence. Faced with the task of reviving the SGX's fortunes, Mr. Loh set out to position the exchange as a gateway to Asia and to different asset classes. Over the past 4 to 5 years, the SGX has been building on its multi-asset capabilities. It now offers a full range of products, from equities to fixed income, currencies and commodities. Recently, SGX ventured deeper into the forex markets. And Mr. Loh explains why he sees forex as an important growth area for the exchange.
The overall FX market is the largest globally. It has over 6.6 trillion US dollars of trading volume or trading value daily. That said, the FX futures market is a small percentage of that, something like 2%. A large part of the FX volumes are still done electronically, but over the counter. Having established a leading position as the most international exchange, largest for Asian FX futures, we see the trend of bringing the two pools of liquidity into one.
So SGX now has full ownership of BidFX. Can you elaborate for me just what benefit this is going to be for the exchange?
I think the future of the FX market would very much depend and rely upon the price transparency, bigger pools of liquidity, and I think more importantly, how the workflow process for customers can be made even more effective and efficient. So with BidFX, it can now also offer solutions to customers, not just for liquidity, but be able to provide them an end-to-end process in terms of order aggregation, in terms of trade allocation, and also more importantly, being able to do cost analysis for transaction.
The BidFX deal comes in the wake of the loss of MSCI contracts. In May, MSCI ended its 23-year-long partnership with the SGX. That means from February next year, SGX won't be able to offer futures and options contracts linked with the MSCI equity indices. The only exception is MSCI Singapore derivatives and options products. How confident are you, though, that the growth in your derivatives business, in your indices business, is going to be able to bridge the gap that's been left by the loss of MSCI?
We organized our business last July into 3 verticals, an overall equity business, the data connectivity and index business, and also a new division in fixed income, currency and commodities. The DCI business and the FICC business will double in 5 years' time. So that's really part of our growth strategy. But with equity derivatives, we are refreshing also our product and service offering. So it's not just about replacing some of these contracts. We also offer new contracts, new products such as ESG, where investors are demanding sustainable investing. We will have ESG variation of some of our benchmark contracts. We will also offer REITs, Real Estate Investment Trust futures. So it is about refreshing and new offering.
A refresh is needed for the equities component of its business. SGX has seen delistings since 2014, with some well-known names like Global Logistics Properties or GLP bailing out. Perennial Real Estate is the latest counter that's set to delist.
I think companies delist for different reasons. Some not being able to meet and comply with listing rules. Some may have a change in business direction. Some may have a tougher operating environment. But that said, the companies that come to list on SGX expect a continued journey in terms of fundraising. They don't see an IPO as a destination. They see an IPO as the first step of a journey. In the last 5 years, our companies that are listed have raised more than 4 times in the secondary market compared to broadly when they first listed.
The Singapore Exchange has also seen a dearth of tech startup IPOs in the last few years. In 2017, 2 high-profile Singapore startups chose to list overseas. They included gaming hardware firm Razer and gaming and e-commerce company Sea. To attract more tech listings here, SGX last week deepened its partnership with Nasdaq. This will make it easier for Nasdaq-listed firms to seek a secondary listing on the exchange.
When we first pioneered the first equity index derivatives almost 36 years ago, we had never stopped and stayed static. We continue on that path of innovation. We will continue to evolve with more and better offering for investors, riding on our strength and our ability to continue to innovate, and also being able to look ahead